Welcome to the SPAC Alpha web series. My name is Dan Dombroski, and today I want to take a step back from SPACs and get some insight on what's going on outside of the space. So I asked Kuppy Kupperman, better known as Kuppy, to come speak with me about energy, commodities, and real estate. Now, if you haven't had a chance to listen to Kuppy, this could be a great introduction because he does a great job of cutting through the noise and offering some fascinating takes on global events. So with that, please enjoy my conversation with Kuppy Kupperman. Our audience is more skewed towards SPACs. So could you give some background on yourself and maybe how you look at the world?
Sure. I started investing in high school instead of going to class, and never really done anything else in my life. In terms of investing, I run a hedge fund, very successful, put up some pretty big numbers, and I think I take a very different view than most people. I'm trying to put up rolling 3-year returns that are the top. Just at the top of the performance numbers compared to other funds, and what else you can do with your capital. And I'm totally volatility agnostic. I couldn't care less what happens day to day, month to month. I find most funds are so focused on avoiding volatility because it hampers their marketing ability that they miss out on all returns. We tend to find that returns cluster at inflections in individual companies or sectors. Often things that are hated, unliked, stuff that just the world has given up on, and you show up and find a reason why things should get better. I always like to say that the most money is made when something goes from hopelessly fucked to sort of shitty, and that's usually that sort of inflection, multi-bagger. I tend to look at companies that aren't the A sort of businesses, A+ businesses. But look at a lot of B businesses that are valued like D businesses. And I found Wall Street is really good at taking something linear like Apple's earnings growth and building a model. And it's really terrible at taking something with a quarterly or yearly earnings volatility. That's companies undergoing some sort of secular change or just basic cyclical commodity businesses that go through cycles. And Wall Street just missed that, and that's where the opportunities are. If you can figure out what the thing will be worth to a private owner, it's often very different from what the thing is worth on the screen at that moment. That's where the opportunity is.
And viewing this from a sizing, concentration, and hedging and leverage perspective, could you dive into that a little bit?
Sure. I believe that you're not going to have that many great opportunities in the world. I run a very concentrated book, usually 6 to 12 thematic ideas. It's usually either an individual stock or more likely a basket approach to a theme. I'm usually tracking macro themes, but usually not the big macro stuff like interest rates and currencies and the price of gold. I'm usually tracking the next tier down stuff that no one's paying attention to. And there's not usually that many good themes at any one moment, so we're going to be concentrated. Usually my top, I say I have 6 to 12, it's usually like 5 or 6 themes. And usually that makes up the whole portfolio. Usually, 5 tickers make up 75% of the portfolio. I've learned that leverage is your friend, but it can be very dangerous. And it's better to keep exposure low. And, there's a few moments every decade where there's an opportunity to do something really brilliant and you can up the exposure. But otherwise, it's better to have extra flexibility. We target like a 115 to 125 exposure, almost only long. And in this moments like now, where the market comes straight up for 2 years, we're probably going to be a little bit below that 115 to 125 range, and we're around 105 right now. But it gives us a lot of flexibility to grow this up.
So how does this play out when you're looking at these plays or thematic plays from your risk tolerance that may be different from your custodian's risk tolerance, and you are playing with leverage?
Well, it's minimal leverage. I tell all of our LPs before they join the fund that my expectation is that about every 18 to 24 months, we'll have a down 35. And if they're, not ready for that or not excited about that, because I'm excited when we have a down 35. We can buy a bunch of stuff really cheap. But if that's not how they view the world and their own risk portfolio, then they're not right for our vehicle. And hopefully it self-selects people that really do enjoy the volatility. We've had 2 years in a row where we're up over 100% net, and you're not going to have those sort of up years without some volatility along the way. It's inevitable.
Could you elaborate on your relative value approach?
I'd like to have positions that offset. So if one does well, the other one likely, maybe it'll go down. I like offsetting things. I like to hedge. I run a mostly long book, and I like hedging through longs. I think the best way you can reduce your risk, though, is to buy things that are unusually cheap. You buy things at fractions of replacement costs. You buy things with strong balance sheets. You buy things where the insiders are buying. If you buy things that trade at single-digit earnings multiples, cash flow multiples, it's hard to lose money. You have to understand, I'm looking for 5 and 10 backers. That's what I'm doing. And you get a few of those right each year, and you have big years. And a lot of people look at 5 and 10 baggers. They look at things where they can lose a lot also. And I hate those situations. Right. I really want to look at situations where I get it just totally wrong and I get my money back, or maybe at least 10% or 20%. But, I'd say I get a lot of these wrong. I get my money back plus a little. And, if you get things that can offset each other, it's even better. You have a good example. I'm long a bunch of uranium, physical uranium through SPAC Physical Uranium Trust. I'm also long the largest uranium producer, which is Kazatomprom. If Kazatomprom or Kazakhstan has an issue, I might lose some money on my Kazatomprom. But SPAC Physical Uranium is going to go intergalactic. I'm making 100 times on my uranium long there, and I'll lose some basis points on the other side. I'm not saying I expect Kazatomprom to have any issues, but it's nice to know that I can bullish uranium and have both sides on. And vice versa, if Kazatomprom decides they're going to increase production dramatically, and the price of uranium probably go up much more, but Kazatomprom absolutely just drowns in profits, and they're going to pay that out to me in dividends. And I won't make as much as I'd hope to, but I'm going to get some pretty nice dividends from Kazatomprom. And I expect the price would appreciate dramatically too if they ramp production. It'd be probably terrible for every other producer of uranium, but Kazatomprom is a low-cost producer, so they can really set the market price. And they have plenty of excess production capacity if they wanted it. So you look at these things kind of offsetting in a way.
So could we take a step back from that and look at your overarching view of uranium?
Sure, yeah. When you look at uranium big picture, and I do a lot of commodity investing, commodities are about supply and demand. And frequently, commodities swing wildly between being priced below the marginal cost of production and above, based on just supply and demand imbalances. And these cycles have been going on since the start of time. And what I like about uranium in particular is it's somewhat idiosyncratic. It's not tied to broader industrial commodities that are tied to GDP. The uranium cycle exists in its own little universe. In the end, you don't have uranium, you don't have any electricity, and your power plant doesn't work. And so the world needs uranium to operate power plants. And for a very long time, uranium was below the marginal cost of production. Mines shut. There was a big glut of uranium and a bunch of mines shut. And now we've worked through that glut. The world produces about 150 million pounds a year of uranium. It uses about 185 million pounds. But those stockpiles are running low. And at some point, the price has to recover to a price where mines restart, new mines get built. Uranium demand is going to grow all decade long. You have a bunch of new power plants coming online. We also have a bunch of power plants in Europe and the US that were expected to be mothballed because they reached the end of their useful life, or a bunch of political zealots wanted to go shut them down because they hate nuclear power and progress. And so those mines will likely stay on going forward. So that's just going to add demand. But we'll be well past 200 million pounds of demand by the end of this decade. And so eventually you have to produce that from somewhere. I bought my uranium last year when physical was trading about $31 a pound. It's right now about 60. I think the marginal cost of production is probably around here, maybe a little higher. So you need 70 so that people have some profit motive. And if I know anything about uranium, it tends to be one of the more volatile metals because when utilities start running low, they panic and they chase the price around. And I expect that to happen this cycle as well. Added to that is the fact that there's this entity called SPAC Physical Uranium Trust, and that entity issues shares and purchases physical uranium, and that will or has been reducing the available stockpile, and I think it will continue to reduce the stockpile. And as the price goes up, I expect investors to chase it because people like things that go up, and it'll keep front running the utilities, and you'll have price discovery, and then it'll probably trade at an excess price. That's how these things normally go. And Now, I expect uranium to overshoot probably in a wild speculative level. And then I'll get out and play the next uranium cycle 15 years from now again. It's my second uranium cycle. But no, I think uranium is going to be a really interesting place to invest. And somehow it's become ESG friendly because uranium has become a green commodity, which is kind of hilarious because I never thought I'd ever have anything that's ESG friendly in my portfolio. But it will lead to additional speculative inflows as ESG funds and portfolio managers chase uranium.
Could you talk about how you would view or define what ESG is?
Oh, ESG is when you buy mostly frauds. It's portfolio managers that want a moral social justification for buying frauds. I think most ESG, like ESG started as a useful thing. You know, if you invest in companies with good corporate governance, you probably will do better. If you invest in companies that aren't destroying the environment, it's probably better for society, and those businesses probably should do okay. You know, if you take care of the communities around you, it's probably good. I have no problems with ESG. What's happened is that, like most things, it's been horribly bastardized, and it's not even caring about corporate governance anymore. It's more about, if you could check different boxes on who the board members are, as opposed to, are the board members doing their job correctly? And you've ended up with a lot of institutional capital allocated based on ESG mandates, and as a result, CEOs have taken up these ESG pledges and goals, and a lot of them are not profit maximizing. And and you also have a lot of unprofitable businesses pursuing so-called ESG things, green technology and whatnot. I don't know. I don't really own a lot of ESG stuff, but I don't see why a coal mine can't be ESG friendly if they, follow appropriate corporate governance. That's obviously the most important to me because I'm an investor. A board exists to ensure the CEO does his job, doesn't embezzle money, doesn't do related party transactions. Social, if you're hiring a few thousand people, you're probably helping the community. A lot of these mines give back in terms of schools and hospitals and all sorts of local community things. It seems like social and environmental. Look, coal is it produces some carbon. I'm not sure if that's a problem or not. But in terms of producing high density fuel that the world needs, I think that's a great thing for progress. And I don't see why coal has to be bad and lithium has to be good. I mean, you ever looked at what a lithium mine looks like? These things look like Superfund sites. I just don't understand why one's good, one's bad. They're just commodities.
What do you think is the biggest driver to this ESG bastardization?
They've created a religion to replace traditional religions. It's stupidity. Like most manias, I think we're pretty much at peak stupidity, and then we'll look back at this and all laugh. And, hopefully, I'll take most of those idiots' money.
So this does sort of segue into your more long view of energy. Could you dive into your oil thesis?
Yeah, if there's 1 billion people in the first world that have a certain standard of living, and 6 billion people in the developing world that want the same standard of living I have. And a lot of those people don't even have a refrigerator. As they acquire wealth and move kind of up the wealth chain, I think they're going to buy all the toys I have: air conditioning, refrigeration, lighting, vehicles. They're going to start jetting around the world. I believe in human progress, and human progress has always meant more energy consumption pretty much every year for millennia. The energy consumption goes up, and it's accelerated now. And meanwhile, you have a bunch of people in Western countries that hate human progress, and they want to reduce the production of energy. But if you have consumption keep growing and the production declines, it's going to be resolved through higher prices. That's how commodities work. And I think a lot of these people, kind of tongue in cheek, really do want oil to go much higher because it makes some of these green energy projects, which aren't really cost effective or return on energy effective or any of this other stuff that, there's lots of ways you can look at green projects that are mostly failures. But they want these things to be more I guess competitive against traditional fossil fuels. And as a result, if you take the price up, they become more competitive, at least on a cost basis. And I think that's what they're trying to do. I think, they intuitively know that if you create an energy crisis, people start using windmills more. And, they intend to create an energy crisis. They pretty much told you they intend to create an energy crisis. You see Europe just had a whole winter of energy crises, and their only solution is to poke Russia so that Russia shuts off the energy. Like they want a crisis. And so if they told you that they want to have an energy crisis, then you should believe them, because governments are pretty terrible at building things, but they're great at destroying things. And if they want to destroy the energy sector, I think they'll succeed beyond their wildest dreams. And so we own a lot of oil. I think global demand is going to be, it's growing 1 million barrels a year, more or less, for quite a lot of years. And there's some good and bad years, but it's around 1 million. I think it's going to go to 2 or 3, maybe even 4 million barrels. And that's just 6 billion people catching up. And at the same time, the supply side is not going to grow. It might even shrink. And the net result is that price is going to go crazy. And we've seen all the politicians, we've seen Larry Fink, we've seen them all say that they intend to make oil go up, and I believe them. So I own a lot of oil. It's been good to me.
So what are the actual implications, do you think, of, let's say, oil at 200 or 250?
I'm going to make a lot of money. I don't know. I'm not here to predict global politics or anything. I think my portfolio is going to do quite well. Look, I think at 200, I don't think you have much demand destruction. If anything, what we've seen governments do, and I predicted this in my blog 6 months ago, is that they'll give out stimmies, and the stimmies will be used, they'll be given out to people. Energy inflation and all inflation, it tends to harm people who aren't wealthy. It harms middle class and people who are just trying to get by. And I think those people end up getting stimmies from the governments. The governments can print dollars, they can't print oil. And they'll give stimmies out, and they'll just keep demand roughly constant. For all you know, demand actually grows through the stimmies. I have a friend in Saudi Arabia who likes to joke that energy is so cheap. When it's 120 degrees in the summer, they run the air conditioning and they keep the door open. They just don't care. I can see the same sort of thing happening here. If you give people something free, they're just going to waste it. And so I just don't think anything will happen at 200 on the demand side. And on the supply side, I've already said they're making it impossible. They're banning drilling permits. They're not allowing new pipelines. They're cutting off access to capital. They're already talking about excess profits taxes. I mean, look, it's a commodity. The history of commodities is, you have a couple good years, you have some really terrible years, you have some mediocre years, and it's the 1 or 2 good years that pay you back for all the mediocre and terrible years, let you pay down debt and reinvest. And if you cut off the good years, well, then no one reinvests. And so I think it's almost inevitable that oil goes higher. You should own a lot of oil.
So then, rather getting ahead of it, they're just like, we'd rather take credit and show you that we're taking care of you.
Yeah, that's usually what governments do. They hand stuff out to people and kind of ignore the problems they're creating. But I guess most governments, they don't actively try to destroy things. It's just inevitable because governments are usually corrupt and incompetent. I think our government's genuinely malevolent, and that it's trying to destroy energy. Biden's rooting around going to Venezuela and Iran, all these people that hate us begging for oil, where you have a bunch of boys in Texas that really want to produce oil and you won't let them. It makes no sense.
I'd like to get your take on what happened with the LME with canceling trades on nickel. What do you think of that?
Oh, well, that's criminal. I mean, if you put a trade in, you expect them to honor it. And look, I've traded a lot. I've had some errors before where I've been told at a crazy price and I called the exchange and they cancel the trade. At the same time, they've called me a couple of times and said this trade was clearly an error. and we'd like to cancel it. Are you going to just dispute it because there's a dispute mechanism, and but I know I'm not going to win the dispute, and so I'm just going to waste a bunch of time. So I agree to cancel the trade. And this happens with something that's clearly erroneous, but when you have a speculator who's on the wrong side of a trade and you cancel trades because he has a margin call, that's just criminal. I think it's destroyed all credibility of the exchange. And I think we see this problem with a lot of exchanges because the exchanges themselves don't have a lot of the physical metal that backs the paper. And so if people actually demand the physical metal, I think you're going to see a lot of these exchanges fail because there's not enough metal in their warehouses. I mean, this has always been kind of a crisis that's been brewing for a long time and never really been tested. But I see that as a clear problem because the exchange has relatively thin capital to stand behind their members and trading firms. But what they did to bail out a trader, I mean, they've said basically that he covered a few of his shorts when the price went down. They artificially basically had a crash, and we're up limit 2 days in a row. He's just going to have another margin the other direction. I mean, I bought some nickel. I know nothing about nickel. I didn't know what the ticker was, but I know when I see someone who's trapped. I bought a few for giggles. I'm actually up about more money than I expected to be. It's good. It's good for me.
No, short squeezes really aren't any new market phenomenon, but it does feel like we hear about them more and more. I don't know if that's a function of more retail participation, such as with GameStop, or outsized position concentration. But what do you see as a primary driver for these moves?
I think what's happening really is ETFs causing the problem. You have an ETF and it's told that it has to buy something. If it has inflows, it has to buy it. And so if GameStop is one of many stocks that it has to buy, it gets inflows, it has to buy it. It doesn't really care what the price is. And all these ETFs, as something like GameStop's market cap increases, the weighting in the ETF increases. It's very reflexive. The weighting goes up, so it has to buy more, which means the weighting goes up and you have to buy more. And you end up creating weird bubbles and weird feedback loops. The GameStop is just unique in that you had a couple of large funds that were short all the shares outstanding. I mean, it's insane to short that much because you're going to leave yourself exposed. In finance, you see a beached whale, you harpoon it, and it's kind of like this nickel guy. He's short more contracts than he could possibly deliver the nickel. And as a result, everyone's kind of harpooning him. In GameStop, you had a guy who was stuck and everyone went after him. I think you're going to see that more, but that's just because people, you have ETFs 1 and 2. I think you have a lot of people who come into the markets and they don't understand the markets. They don't understand how liquid and thin the markets are. And strategies that worked when you ran, a few dollars don't work when you run a few billion. And if you try to put on the same sort of positions, maybe it'll work for a bit, but one day it stops working and you're trapped. And I think we've seen this a number of times with guys on the short side where they just didn't understand the market impact of what they were doing. And as computers get to be bigger, you're going to have more of these sort of situations, I guess. But I think it's more just a function of people putting on idiotic positions and then everyone just kind of harpooning them. And that'll go on to the end of time.
What do you see as the largest redundancies or barriers or the interventions within the system that you see that don't need to exist?
Well, I mean, on the short side, I think there should be limitations on your ability to short a certain percentage of the company. In Europe, if you are short more than a certain percentage of the company, you have to file. In the US, if you own more than 5% of the company, you have to file a Form 13. And then you have reporting requirements as you increase your position. Europe has the opposite, where if you're short more than a certain percentage of the company, you have to file on it. I think that will make it less likely that people go out and short 10 or 20% of a company because as soon as you file it, everyone knows you're trapped, and if you're short, you have to cover it. Let's go bankrupt. And I think you're gonna have situations where people are less willing to go short a large percentage of the company. But this sort of short squeezes. This has been going on for 200 years. It'll keep going on in various forms, and commodities naturally, but also in equities.
We transition over to real estate and look at your thesis there.
Well, housing is a commodity. Like I said, I like doing commodities. I like doing cyclical businesses. The U.S. used to produce over 1 million single-family units until 2008. Then for over a decade, we produced like 700,000 a year. And between the U.S. population continuing to grow and the lack of housing construction, there's like a 5 million home deficit right now in the United States. And you also have a number of demographic trends. You have people leaving the high tax, the kind of shitty states, I guess, and they're moving to Florida and Texas and Tennessee and all the lower tax, less regulated states. And so it's not just 5 million homes needed, but you have this demographic change as well. And so maybe the number is 6 or 7 or 8. I don't really know. And you have people my age who put up having kids, and they're having kids a decade late, and they can't stay in a studio apartment anymore. They're going out to the suburbs. So all these things are kind of happening at the same time, and the net result is that the demand for housing will go up. I own a company called St. Joe. It's one of the largest landowners in the state of Florida. They own their land in the Panhandle, which I think is the prettiest part of the state. It's got amazing beaches, and they're working with home builders to develop that land. They're building a commercial space. It trades at like a third of the value of the land, maybe a quarter of the value of the land, and that land keeps appreciating every year. It's one of the best gibbies I've ever seen in finance, in that you can buy something really cheap without much risk, and the guys running it, I think, are pretty good. They'll just create value still. I own another company called Builders First Source. It's the largest supplier of building materials to home construction, home builders, I guess. And it's another just great business, increasingly dominant as they buy up regional players. They've gotten some pricing power. The margins are going up. You basically long inflation. I'm long. I like inflation. I think it's inflation is here to stay and likely accelerating. And when you're long something like Builders First Source, you're basically just long inflation with a couple turns of debt. But it trades at a single-digit earnings multiple, and they're buying back a lot of stock. I think it's great stock to own. But that's the two ways I'm playing U.S. housing. I don't want to touch the home builders there on the wrong side of inflation, where they sell a home and they don't know what their costs are going to be, and they try to backfill it, and they can get squeezed on margins. They're effectively just long development land, mostly options on development land. So when the cycle ends, and it will one day end, they're just going to be stuck with a bunch of options that expire worthless. And as we've seen every cycle, these things make money for a couple of years and give it all back. It's a terrible thing to invest in. And they're unusually low return on capital businesses. I like high return on capital businesses. Builders First Source is a 30 or 40% ROIC business. I previously owned a company called Cornerstone. That was a 5-bagger for me in about 18 months. They're the largest producer of vinyl windows, siding, facade, gutters. Unfortunately, some private equity fund bought it out for me, so I got a 5-bagger. But it's just a great sector and a great business to be involved in.
So you see single-family housing outpacing multifamily or rental units?
Well, I think they need to build all of that. The U.S. population keeps growing, and they haven't built enough. That's why rents are crazy expensive, and that's leading to demographic change. People can't afford rent in the Northeast anymore because the Northeast has restrictions in place on development. They've made it so painful to get permits that. And this is the existing owners putting these restrictions in place. They don't have competition, and so it's a commodity product. People are just moving to places where you can build units cheaper and the rents are lower. But until they build more supply, the rents will stay unusually high. If you look at rents, as a percentage of construction cost, you're getting crazy returns on development, and that'll be solved eventually. But what I do is I go find a big trend I like. This is a big demographic trend. I think it's going to be around for a long period of time. I go buy the best return on capital businesses, the dominant businesses. I buy the ones with the most upside leverage, but that's through usually return on capital and valuation. I rarely pay more than a single-digit multiple and stuff. I'm usually paying like 3-4 times earnings, and I like to buy stuff better than 30 ROIC, and then I just sit there and It's funny with these 5-10-year trends. People like to tell you every 3 months the trend's over, and you have this pullback and it's volatile, and then the trend keeps going. Now everyone's worried about mortgage rates. Like, great, you know, your mortgage costs $200 more a month. Like, you know, I don't think it's going to change anything because you save more than that in state tax. Like, I think people just like to hate things that are working. But in the end, housing demand is here. It's going to be here next year. And I think the companies supplying building materials, or in the case of St. Joe, supplying land, are going to do great.
So just to clarify, you see it really just as a rising tide, but you mentioned the Northeast and how there seems to be zoning issues.
Well, there's lots of places with zoning issues. You know, all of California is painful to develop. You know, and the net result of that is that the rents are artificially high. But you can build as much as you want in Texas, and that's why you can get yourself a nice McMansion for $500,000. And you know, I think that's what people are going to move to, because it's great to go buy a 3,000 square foot McMansion. You know, people want that once you have kids. No one wants an 800-foot studio. And so it's just inevitable. That's why you see these demographic moves.
Looking at your thematic plays, what is your highest conviction?
Oh, I mean, uranium, it's almost inevitable. Outside of a nuclear accident, and even with a nuclear accident, I don't think they're going to shut down all the power plants, because it's like 15, almost 20% of the world's electricity. You can't go on forever and consume more pounds than you produce. At some point, you have to catch up and produce more pounds. And you can't produce more pounds if it's below the cost of producing the pounds. You know, so the price has to go up. The question really is, you know, does it take another year? Does it happen tomorrow? I mean, people told me this story back in 2019. It turned out there was over 100 million pounds in the warehouse that had to be consumed. We consumed 100 million pounds. A bunch of financial entities have bought another 50 million pounds. So it was over 150 million pounds more than they would bought in warehouses. It might be another 100 million pounds. I don't know. But eventually it has to work. It's inevitable. You know, I like trades like that. You know, if it's inevitable, it's going to happen. I just don't know when.
Well, I do appreciate you taking the time to speak with me today.
Yeah, sure. Happy to chat anytime.